The shares of Paterson, the US-listed dental distributor, have doubled since the March lows, as dentists have returned to work. This might look great, but the market seems to be ignoring the fact that Paterson has some very deep-seated problems. Revenue is stagnant, margins are shrinking, the balance sheet is deteriorating, and we think there's rising risk that some stage later this year they could breach their covenants. This is all made worse because the board is protected from minority shareholders by legislation, poison pills, and some very large, tame and possibly docile shareholders. Ultimately, the best case scenario, the company just slowly withers away. In the worst case scenario, it breaches its credit covenants and collapses later this year. Before we go on, I must remind you that under Hong Kong SFC regulations, we can't make stock recommendations to the public, and none of what follows should be taken as investment advice. We think the share price recovery since March looks delusional. The business was in deep trouble well before COVID, and little has really changed. Since 2010, although revenue has risen, margin and profit have been falling. These have also been matched by a drop in core cash flow and reduced returns. The first quarter results do nothing to suggest that anything has really changed. However, even these numbers don't tell the full picture because they include the various tricks that have been used to prop up revenue and profits while facilitating the payment of dividends. The problem is that these dividends have stripped the company of cash, and that's why there is a rising risk of default. The key covenant that we're looking at is the one limiting debt to EBITDA. Normally this shouldn't rise above 3.5 times, but it can on occasion be stretched to 4 times. The EBITDA calculation is a little odd because there are some adjustments in there for legal expenses and other one-offs. But we estimated adjusted EBITDA around 170 million in 2020. On a 4 times multiple, this creates debt capacity of around $680 million. The definition of debt is fairly comprehensive and includes debt, leases, swaps, and any facility with a recourse. Notably, it excludes the non-recourse factoring. Based on this definition, they report debt of almost exactly $680 million. This could explain why factoring rose so much in the year and was maxed out by year end. It could also explain why the collateral held against these facilities, the DPP receivables, rose as much as it did. An alternative explanation for the extra receivables is that they're effectively buried bad debt. We can't tell, but neither option is that good for shareholders. There's another intriguing issue. Their interest expense doesn't match up with what you'd expect. Based on the company's disclosure, last year's interest cost should have been around $16 million. However, the actual expense is more than double that at nearly $42 million. There isn't any clear explanation for this. One obvious reason would be if their day-to-day debt levels were much higher than those reported on the accounting dates. One way this might have happened is if they manipulated the working capital at the end of each quarter to reduce the debt numbers. They're clearly happy managing working capital to some degree because over the last few years they've extracted over $450 million from working capital. This has given the appearance of operating cash flow and cut reported debt. The problem is there are limits to this kind of behaviour, and quite often squeezes like this get reversed at the worst possible moments. Normalising their working capital to match that of H. Sheen suggests they've over-extracted about $240 million from their working capital. If this was added to their reported debt, they'd have breached their covenants. The other obvious problem is that if you don't pay your suppliers, they tend to get annoyed, which isn't very clever when you're so dependent on such a few key suppliers. Assuming they can maintain the margins from the first quarter, they should be able to generate around $200 million of EBITDA this year. Multiplied by 4 gives a debt capacity of over $800 million, which is better than last year, but at Q1 they had $780 million of debt. Deduct interest, tax and capex from EBITDA, and the cash flow before working capital should be around $55 million in total for the last 3 quarters. This sounds good, but it's not much headroom when you consider that working capital absorbed $144 million in the first quarter. Even these numbers may prove to be optimistic. In the past, they've used accounting gains on vendor financing to boost margin. Unfortunately, this facility is largely maxed out, therefore those gains and margin improvements may not be possible for the full year 21. As an aside, we're always worried when we see companies using vendor financing. We think of it as the crack cocaine of commerce. Easy to get addicted to, usually requires ever larger doses to create the same effect, and eventually it often destroys the underlying business. The simplest way to think about it is, if you can sell your product at the full price today for cash, why wouldn't you? We see no real benefit to vendor financing. In contrast, it's usually a reliable indicator of a business with an undifferentiated product under margin pressure, and it also tends to support creative accounting. Paterson is a classic example. They've been booking ever more gains, and in FY20 they make up 29% of operating profit, handily obscuring the decline in core margin. This behaviour isn't good for long-term shareholders, but the short-term gains do help management meet their bonus targets. Talking of which, the incentive scheme at Paterson is one of the worst cases of rewarding failure that we've ever seen. In recent years, they've consistently set the performance threshold below the results of the previous year, obviously making it easier and easier for bonuses to be paid. Thanks to this, the CEO's compensation has risen, even though the business has declined. Unfortunately, it's almost impossible for minorities to change this ridiculous system because the board is protected by poison pills, by anti-activist legislation, and some docile shareholders. We're not surprised that the ETFs and the ESOP are such patsies, but we do wonder why T. Rowe Price is failing to live up to its advertised standards. All of this matters because, despite their creative methods and accounting, Paterson continues to fall behind its peers. The old companies like Shine and Covatrus have better margins, while the newcos like Chewy and PetMed are faster growing and more profitable. Finally, we'd caution against relying on the dividend to provide any support. Over the last 4 years, they've paid out close to 100% of the cash generated, but this is obviously unsustainable given how close they are to breaching their covenants. We can't talk about valuation or give recommendations, but we can point out that a stock with limited growth, declining margins and a high risk of collapse is not obviously a company with great prospects. If you want to dig a little deeper, please visit the Paterson page on bucephalus.com using the link below. There you can see the questions we think investors should ask and download some of the recent filings where we've highlighted the key points. To keep up with our reviews, subscribe to our channel or send us an email, and before you go, please remember that none of this should be taken as investment advice. We've sourced the facts from the company's filings, but the interpretation and conclusions are just our opinion. We provide these videos for educational purposes to expose what we perceive to be creative accounting. They're subjective and should not be used as the basis for an investment. Thank you very much for your time.